Why would health insurance companies deny pre-existing conditions? It has to do with how insurance works. One fundamental purpose of insurance is to share risk. Put somewhat crassly, it's a system that takes from winners and gives to losers. This is easy to understand in the less morally fraught arena of property insurance. Basically, how it works is that all of the policyholders pay a premium that is used, in part, to create a fund to indemnify the unlucky ones among them whose houses happen to burn down. Obviously, a scheme like this would be unworkable if everybody's house burned down. The fund has to be big enough to pay the losers. If everybody's a loser, it won't be unless the premium was equal to replacement cost, and if it was, nobody would buy insurance in the first place. Equally, insurance doesn't work if people can enter the pool after they've suffered the loss. In other words, I can't buy insurance after my house burns down. If it worked that way, nobody would buy insurance until after they suffered a loss, and there'd be no winners in the pool to pay the losers. That, in a nutshell, is a problem called adverse selection, which, along with moral hazard, is one of two fundamental problems in insurance policymaking. People entering a health insurance pool with pre-existing conditions are akin to people entering a property insurance pool after their houses have burned down. Allowing them in will cause the pool to become insolvent, as such a policy will cause people to just wait until they're sick to buy insurance. Eventually the pool will contain only sick people, with no healthy people to offset the cost of treating them. Obamacare's answer to this problem is the much maligned but obviously necessary individual mandate. Insurers can't refuse to cover people with pre-existing conditions and can't even charge them higher premiums, but in exchange for that, every member of the public is required to either have some form of insurance or pay a penalty. This stops people from only entering the pool once they're sick, and again, if you allow that, the pool will become insolvent due to adverse selection. And premiums will rise, too. You don't really believe that a health insurer's job is to provide health care for sick people, do you? The key word is insurance company. All of them, save for a few not-profit HMOs and some of the BCBS plans, are organized to make money. Even the HMOs and the BCBS plans want to make money. Health insurers set up their plans to make sure that they have enough money to pay their claims and a little left over. Roughly speaking, health plans expect to pay 80 to 85% of the collected premiums out in claims. They have administrative costs, underwriting, claims, marketing, network management, etc. that eats up another 10%. Most plans pay a premium tax to the states of 2 to 3%. They may pay commissions to brokers and agents of 6 to 8%. If you're following me, we're perilously close to 100% and perhaps over that number. They make money of the collected premiums by investing them. Carriers hold millions, perhaps billions, in reserve, and that income may be all the money they make in a given year. If you think about that 80 to 85% figure, you can see why it is so important to keep the cost of claims down. That is one variable that they have no control over. If they have an especially bad year, the cost of claims can eat up all of their collected premium. The ACA knew that would happen because of the guarantee issue feature. The first enrollees were surely the people who knew they needed health insurance. They were chronically ill and wanted to make sure that someone would pay for their health care. The ACA provided for the government to reimburse the participating carriers for those losses, but Congress backed out of that commitment. Carriers now are fleeing the market because they know that they'll lose money. There is an adage in the business that is really a truism: 20% of the people cause 80% of the claims. So, the cost of caring for one person needs 4 other people to pay their premiums and have no claims. A health insurance company's job is the same as any other company: to make money. And they make money by providing a service that their customers are willing to pay for. Specifically, a health insurance company, or any insurance company, mitigates risk. It does this by making the healthy pay for the sick, so as to smooth out everyone's cost. This way, customers pay some predictably high amount for health care, through premiums, deductibles, and copays, but are less vulnerable to sudden catastrophic costs. The insurance company's profit is based on how well they are able to predict costs, Thus they have an incentive to pick healthy customers who are likely profitable and pay more into the system than they take out, and deny sick customers who are likely unprofitable and take more out of the system than they put in. If they didn't deny pre-existing conditions, they'd have to raise premiums to spread those costs to their healthy customers, and likely drive away customers with the high monthly payments. The healthy, it turns out, don't like to pay for sick people. They could take on the sick customers, but would have to charge them incredibly high amounts to justify their likely costs for the customer, not much different than paying for services with cash. In practice, this prices those customers out of the market, as they can't afford the high costs, often because they're sick to begin with, which prevents them from highly productive work. In short, insurance is about predicting costs, not providing healthcare, and medical costs are much easier to predict when you know who's sick to begin with.